What's up, folks? Hope everybody's doing well. So, as we continue on, we end, hopefully, we end this month, I would say, on a good note. BTC is up, nice little bounce. We did touch like the mid 18,000 range, but we just popped right back up past 20K. So, that's, some hope here towards the end of the month. But on a serious note, one thing that seems pretty interesting. Some hope. One second, guys. Okay. So one thing that seems pretty interesting is the big R word. So do I have to say it? Recession. Everybody talks about it, but do we actually really know what it means? So I want to kind of give a little context to what the definition is and give you guys some insight on what things are looking like, because as we finish Q2 of 2022, that's what's going to be the determining factor if we're in a recession or not. And so, to give you guys the technical term, a recession is when you have two, and this is the United States, definition. I don't know, maybe global, but as far as what I know, it's two condition, or so basically two quarters consecutively where you have negative GDP growth. And so, last quarter we had negative GDP growth of like negative 1%, some change, and then so I've got some things that I want to show you guys today where we have some estimates, and these are estimates that are kind of tracked daily. And for the first time this entire quarter, we popped negative on those estimates for GDP. And so the question is this one of those, crazy 2-year recessions, or is it maybe a COVID situation where we are here for a few months and then we figure our way out? And so those are some questions that I kind of want to dive into today because I have them for myself, but I'm sure you guys do too. So with that being said, let's jump into it. So this is going to be a chill, relaxed stream. Yeah, I'm truly looking forward to diving into this stuff with y'all. So let's get it. Share my screen, but we'll start with crypto and just take a look and see what that's looking like. So let's do this. 1 second. All right, so let's do this first. So we can take a look here on the heat map. Things are looking about like 70-30 in the green. So across the board, your larger caps, we see them turn green. Earlier this morning, it did not look like this. It was actually pretty red, but Bitcoin sitting right here at about 20K and some change. Ethereum just popped back over 1,000, and so we're at 1,100. BNB 226. ADA right around 46 cents. XRP 33 cents. Solana here is at $35. We got Polkadot at $7. AVAX at 17. See if I can zoom in here a little bit. So we got Near Protocol sitting right here at $3 and about 40 cents. VeChain sitting at 2 cents. What else we got? Let's scroll over here a little bit. What else can we see? Nothing's like really popping. Like nothing that just popped off and went up like 15-20%. Especially here within the last few hours. So pretty interesting. So with that being said, it's kind of like a mixed day. What I will say is overall, as we can see, this month has been a tough month overall for crypto. I believe this was, with the candle close, if it closes definitely below 20K, technically it will be the worst month that crypto has ever experienced from a percentage standpoint as far as loss. But like as I always say, it gets better, right? As things figure themselves out, nothing ever stays bad. Just like on the way up, nothing always just stays good as far as price action goes. So we know that these markets are reflexive, and it's just a matter of simple supply and demand. But let's kind of look at nomics and kind of see what we can see over there. Pay no attention to this 7-day price prediction. It really means nothing. So yeah, as far as nomics goes, let's kind of see if we have anything that popped off. AMP. Okay, so 26% for AMP, and then Arweave with about 17% gain, which is interesting. Let's kind of jump into there and see what we can see. How have they been performing thus in the past month? That's the real question. So it looks like just randomly, well, a couple rebounds here. So let's look at year to date. But as you can see, you're looking at something that was 5 cents earlier in January, and now we're sitting at 1 cent here. And so, with that being said, that's an 80% drop just from 4 months ago. So, in the grand scheme of things, yeah, it's not like a complete outlier. It's still trending with the market outside of the positive volatility for the day. Um, so yeah, Arweave. Eh, see, we can look at Arweave really quickly. I mean everything. So if there is somewhat of a rebound in any altcoin, you can expect it to, and if you're a trader, you can expect it to be short-lived. So if you are, up 40, 50% within a day or so, take profits, right? Especially in a bear market, you really have to be quick on that trigger, because the overarching theme, especially if we just click year to date, same thing here. I mean, everything's trending, pretty bearishly. But if you were able to catch a wick low, this is one of those things where you can, kind of increase your bag a little bit. But I would be very quick with the trigger if you are doing any trading. But nonetheless, Bitcoin hasn't really hit a relief rally quite yet, especially within the past month. So yeah, so we'll continue on. So that's just a quick look at nomics, right? I do like nomics because it gives like a little bit different view. You're able to kind of see things in a different way. Let's see here. So global market cap, we're sitting right above 900 billion. So here's the thing. I think getting back above $1 trillion is going to be a psychological thing for a lot of people. Seeing it as like, hey, especially if you look at some of these larger players, they look at crypto and they see, well, it's risky and also it's small relative to other asset classes that they could potentially invest in, mainly equities, bonds, and real estate. And so, not having this T on there, so we got a B, is something to where we may need a little bit of retail push here. Now, as we continue to drop lower, as we're seeing, right? There's going to be that level of where it just gets to the point to be too much of a discount, meaning Bitcoin, that people just can't resist, right? And so we're just in price discovery till we find that point, and there's a consensus of demand at certain levels. Because as we can see, there has not been a point in time where we've held up for, especially since we've been dropping since April. We haven't had a point in time where week over week we're starting to level out, as far as price goes. And so until that time gets reached, just be vigilant and just keep that in mind. So really, let's kind of go and check out Bitcoin for a moment. I did have some other things. So coming up here, we'll look at the PCC because I know that's a chart that I kind of put out a while ago, and it's actually a very helpful kind of a leading indicator, right? Because we can look at the derivatives market and see how are they trying to price things in as far as um, looking at that. And then also, I want to look at different recessions, and we're going to look at the Nasdaq and see how the different recessions affected the Nasdaq. Since we know that a lot of these larger companies and entities are treating Bitcoin like a tech stock, and then so as far as Bitcoin goes, we know the rest of crypto is going to go. So really quickly, let's stop in here with the PCC. And so this chart, let me blow this up. Let's do this. So this chart is very helpful because it gives us an idea of the put to call ratio. So how many puts are being put in the market, basically people hedging and believing that price will continue to go down versus calls. So when we have a lot of calls in the market, that means people think that the price is going to continue to go up. So we have this at different levels. So we have the extreme greed and complacency, meaning, hey, this is typically when prices are trending higher across the board. So for mainly equities and especially crypto. when we get to these levels, these are kind of like the, hey, if you haven't taken profit yet, you probably want to think about doing that. So especially if you guys, realize as we hit COVID and prices bottomed out, right? So this metric tops out, and then there's that nice bull run after COVID. And so that's what, that would be nice to see, is to kind of have, like, I call it like the round trip, where basically you go from a top of a metric to the bottom, or the bottom to the top. So it was a nice, steady, pretty quick, bull run. And then we're kind of on this slow grind, especially downwards. And so, with that being said, in recent times, so back when I was kind of first talking about this in May, it was okay. We're finally getting to this point, because what we've seen here, typically on this metric, on this white line, is kind of a pivot point. So, like a portion here, portion here, here, and this is all throughout time, because with this metric, we can take it back all the way to 2008. And so, portion here, here, especially so, like when we get to this dotted yellow line, this has proven and shown to be, like that max pain, as far as like a lot of people being extremely bearish. So therefore putting a lot of calls in the derivative market. And so, with that being said, COVID was that instance where people, that max capitulation, that max fear, when we got to this dotted line here. Okay. And so, like I said, typically when we get to this white line, that was an area. And so, if you guys remember this date, right? So, this was the whole Luna debacle on May 9th. And that's, that peak fear. But also, on top of that, it wasn't just Luna crashing. Bitcoin price going down forced a lot of liquidations that cascaded price down even further with the wick. And so, but also across the board with the stock market, that was just a bad day in general, right? And so, once again, here, if you kind of see like this double hump here, uh, what we just experienced a couple weeks ago, or what was that? Yeah, about a week and some change on the 17th of June, right? We experienced another wick that was pretty crazy, and that was across the board, not just in crypto, but that was that was across equities as well. So the interesting thing is, if I'm to kind of zoom in here and we take a look, now we came back down, so settled down, so people are not as bearish as what they were a week and a half ago, but we kind of see this curling up. So what I'll be looking for over the next couple of days, if we start to curl back up, generally that's a sign that we'll probably retest this metric here. And so, that'll just breed to more people betting to the side of us going down, which generally this has done a good job of showing us that that does in fact happen price wise, therefore after, right? So this will be something. And then the biggest thing is what we want to see for long term is for this to wherever it's going to top out, whether it's here at this metric at the white line, or if we pop up here to the yellow dotted line, which that would be like, hey, things are getting very serious as far as max fear. What we'd like to see is that same round trip. So where we start to really come down pretty heavily and start to attack this extreme greed, which therefore price follows after that. And so that would be nice to see. And so through time, we'll keep tracking that as well. Now, from there, I did want to take a look at the Nasdaq. So, as we kind of understand the Nasdaq, what we can see and understand, and what we know as of now, Bitcoin is extremely correlated to, especially the tech sector within equities. And I mean, what do you expect? Bitcoin is software, and this is technology. And so, over long periods of time, this has done extremely well compared to the S&P 500 as far as the percentage gain aspect, especially since this drawback here in 2000, 2001. But so what I have here is just a easy to read chart of what the last few recessions, so the last three recessions that the Nasdaq has been through. And so since Bitcoin technically has not gone through a recession, this is maybe one of the closer comparables that we can look at. And we can just take a look at price action to when the recession was announced. So the beginning, right? So the beginning of each one of these little columns here is when the recession was announced, right? To the end of the recession. And so the thing is, markets have a good job of pricing things in. But if we want to take this back all the way to the 90s, and we want to look at this recession back here in between June of 1990 and February of 1991. We're looking at about 259 days. And if we kind of zoom in and just really take a look, what do we notice is like midway through that recession, price recovered. And then so typically the announcement of the recession is the lagging indicator, just like, well, I'll say this. So when they are announcing that we're in a recession, that means we're already in the middle of it. We've already been through it, you know, because typically, our policymakers are not good at letting us know, hey, like things are really, really happening in a negative sense of where this GDP is going. They try to hide it. But even though we can experience it as consumers and we see it, but so when they announce it, typically prices have already started to go down. But if you kind of take a look here with this one in particular, right when they announced it, that's kind of when you started to see a good bit of time. So we're looking at a good like 4 months of just negative price action. So if you want to take a look and just do a percentage drawdown, that was 31%. So we're already at that point. And they have not announced a recession yet. So we're already at this 30% drawdown for the Nasdaq. And so, I mean, I think this one was a little bit lighter. We'll have to check and see if inflation was an issue at this point in time, but I don't think it was. But nonetheless, what do we see midway through that period? So that next 6 months thereafter, you see an incredible uptrend. And then so back on the upside, you've seen price regulate and get back. And so typically, after you have a severe downtrend, what's these? Just imagine a wave, right? Imagine you're watching the ocean, you see a wave come in. It comes in, and then it comes out, right? So price goes down, then it goes back up. These things are reflexive, okay? And then so we'll head back, and this is the whole dot-com bubble. So the recession was not announced until things got really, really. I mean, this was pretty interesting because this was by far the most drastic downtrend that the Nasdaq has ever seen. And so this dot-com bubble, all of these companies that were, just freshly kind of, coming out and doing all this stuff, IPOs for the internet, all this stuff. That's an 83% dive for the tech sector. And that was something that the tech sector has never seen. And we haven't seen that since, even with the financial crisis of 2008. And so the interesting thing here is that the recession really was not announced until halfway through this bear market. And so this one was interesting because, I guess technically from a GDP standpoint, right? From a GDP standpoint, it didn't last the entire bear market. So technically the definition of recession did not last, even though there was more downtrend to go. And then so the biggest thing is what I think we can take away is don't let just the definition of recession make you think that price action is only going to go a certain way or be bad, right? Because what we've seen, like for example, even though there was a recession or currently in recession, you still see positive price action here, and then and you did see a small rebound here, but vice versa. Even though GDP was okay here, definition wise, there's still downtrend. So the biggest thing is you can't use the R word recession as an indicator on how the market is doing. You have to do a little bit more digging. And so, just for example, here the recession. So this is 2007 and 8 financial crisis, and the biggest downtrend was kind of right there in the middle. And then biggest thing there started to rebound well before the GDP got back to that positive point on a quarterly basis. And so you can kind of take this information. So we're looking at 3 cases, right, which is not crazy amount of data, but it's better than zero because Bitcoin has zero data of how it's done during a recession period. So as we go into, and we'll know for sure, but as we go into July, and if we indefinitely have that recession from a definition standpoint, it'll be uncharted territory because just in general, when people hear that, especially as consumers, what do? They start to tighten up with their money and they think everything is doom and gloom. And it really takes their R word to actually make them realize that we're in a recession for average people, I'd say. us here who pay attention to investments and stuff like that, especially crypto, we've already known things are bad because we're investors, and so possibly you may have seen your portfolio go down. And so from a standpoint of a consumer, most consumers aren't investors, and so they're probably just going to get hits with the R word, in the news, right? And so, with that being said, we'll see how the market reacts from that standpoint. So, I think the biggest thing is as we kind of dive in today, and so we kind of look at where we're at, and like I said, we've already done a pretty big retracement from the top for the Nasdaq. So at its worst, we were at 33. So we just popped back right here to about 31%. And if we kind of mark the beginning of July as beginning of said recession, so to speak, and we will see what the rest of this process looks like. And so I think the biggest thing is just keeping your cool and seeing that every quote unquote recession is a little different. I think there's some recency bias, and I mean, and even COVID technically. So actually, I did not plot this one out, but technically, COVID, right, was considered a recession because we had 2 quarters of negative GDP. So even that period, but as we can see, this was pretty quick, V shape, and the time period was almost like insignificant. If you caught it, this is like a flash. If you didn't catch it, you lost out. But if you caught it, you were able to have an incredible return on your capital, especially the year and the year and a half after. So as we can see, recessions last for many different time periods. This one was, like I said, probably the recency bias of people who are maybe in their 40s and 50s, right? Or even in their mid 30s, right? This is what they remember last, as far as things getting pretty bad. But as far as a lot of people, unless you know people who are older investors who experienced this one here, and if you know someone that was quite a bit older and they were investing in the early 90s. I think it's just good to look at the difference between everything and understand that not everything is the same. And so as we continue on, we'll just see of what that R word may do to the markets once it officially gets announced. Da-da-da. Cool, cool, cool. So also, let's take a look here. So why am I even bringing this up? So here's an interesting piece of data, and here's a great link. If you guys are not utilizing this link to kind of look at some macro things as far as GDP goes, I'd really encourage you guys to take a look at the site. So it's the atlantafed.org, so governing body. And what they do is they actually they give really helpful estimates. And so their estimates it's like a daily tracker. And these estimates, I mean, even if you were checking this a year ago, it's been pretty spot on with what reality is. And one thing that we've seen, so if you kind of take a look at this blue chip consensus, this is what you'll hear on the news, essentially, right? Hey, we're sitting right about 3% GDP, 2% GDP. That's positive growth. That's what you'll hear. But reality shows us different. And then so the Atlanta Fed GDP now estimates is more of what we are actually experiencing real time, and that's the key thing. And so what you can see here is that we've hovered below or we've hovered above that midline of zero, so positive GDP, for the entire month of May, and then as well as June. And so, but what do you notice? This downtrend is obviously a real thing, because if you just kind of look in your memory bank and just remember these couple months here. So just remember yourself as a consumer. Remember yourself if you have a business even, and just think about how things kind of turn and see as a business. Did your numbers change? Did you kind of see maybe the revenue was a little bit different? I know that was the case for a lot of people as a consumer. Hey, did you notice that you kind of want to not spend as much money because its prices just seem to be just a little out of pocket these last couple months? And that's how you get a real sense of what's really going on, not what they're saying on the news, right? And so, like I said, this is a pretty good reality check here. And so, one thing that I've noticed and what we're seeing, and if you kind of look, especially within, so the date today is what we're at, sitting on the 30th of June. And so, what we see here, especially like on the 29th, and especially today, we went negative for the first time. So, their estimate was saying, hey, we are negative for the first time, essentially this quarter. And so, like I said, this is a daily tracker. Now we'll see what ends up happening, but nonetheless, I would venture to say that there's a lot of credence here because, I mean, we see it, and we'll definitely see how this goes, especially this first month of Q3. And so, nonetheless, this is it's pretty interesting. So, latest estimate -1%, right? And that's just exactly what I think that we're experiencing here. So my thing is, I want to give you guys an honest assessment. I am not a Uber bear. I am a long term bull. I am like brazenly long on good quality cryptocurrency. And so, but with that being said, I'm not oblivious to what's going on in reality. So in the short term, yes, things are looking a little tough. But in the grand scheme of things, the asset class of crypto is where adoption is going to continue to happen solely because a lot of people understand that the dollar's not going to give them much return through time. And then at the end of the day, people follow innovation. And that's exactly what cryptocurrency is. And not all tokens or coins are cryptocurrency. And that's a whole nother conversation. Understanding what cryptocurrency really means and what it really is a big deal. Because some things are not crypto. Anything that involves you giving your coins to them, you have left the crypto realm. That's something of what they call securities because you're expecting certain things. So those are financial instruments that crypto was not made for you to give away your value and hope that someone's going to take care of it for you. But anyways, that being said, so I did want to look at a few other statistics that I think that are pretty interesting here. And then we'll look at Bitcoin to end it off, actually. And so this one's pretty interesting because this here is tradingeconomics.com, another link that I think is super important to just kind of keep up to date as time goes through. And so you can look at things from the markets, right? You can look at currencies, stock markets, GDP, labor, healthcare, right? Different things within the government budget, the government debt. Actually, we'll be looking at that one here in a second. Housing. So all the people who are kind of understanding, I think this is a really great resource for real estate agents. If people know how to understand this stuff, they can understand how the real estate market is going to move because real estate is the last thing that really moves price wise. It's more of a landing, I would say a lagging asset class simply because it's not as liquid and people's home and real estate investments are the last thing that they'd probably give up if they did have to liquidate something. And that's just the process is a lot slower. So, but understanding a lot of this stuff can really help a lot of real estate agents if they know how to quantify data, right? So, I love real estate. I may do a stream on that. But so as we're looking at this here, and so the biggest thing is reading what we see here. So the gross domestic product, so GDP in the United States expanded 3.5% in the first quarter of 2022 over the same quarter of the previous year. And so this is a year over year assessment, not actually what happened for that quarter. Because if we look here, right, so this last quarter, this is what actually happened, negative 1.6% GDP. So with the estimate, right, so with the estimate of negative 1%, that would give us our two negative quarters in a row. So that's how I'm kind of quantifying this data and just looking at it. And then, like I said, just through experience and kind of understanding what's really going on. And so through time, as you can see, especially since July, year over year, it's just kind of been looking pretty mundane. And obviously 2020 was just overall a bad year. And that's why we did have a full-on recession at this point. And so, that's something to think about. And then, another thing is because people wonder, well, why are prices going up? Why do we have to pay more for things? Consumer prices, so CPI. And that's the CPI inflation. Well, it's just sometimes you have to peel back the layer and understand, well, before consumers, what do consumers, what do? They consume products, they consume services. And so you got to understand who are the people that offer this stuff. These are businesses, these are entities. So these are basically what? Employers. So generally, employers and businesses, they have cost, right? Because you have to pay your employees, one. But not only that, you have to pay for increased energy costs. You have to pay for increased gas costs, whatever it may be, especially if you're doing logistics, right? and you're getting your inventory shipped from another country, all that stuff costs more, especially for big box retailers and just in general for people doing business. So that's the cost of doing business. So traditionally, part of that cost gets passed on to the consumer. So that's why inflation exists. And even before that, also the cost of capital. So for businesses to expand, the cost of capital is another thing. They can't expand as much as they want to, or as what they were doing, if the capital that they want to borrow, the interest rates are higher. And so that means there's less liquidity and money for them to utilize. And so the piece that I want to kind of talk about and focus on is the United States employment cost. So how much, so if you're a business owner, how much does it cost you to have employees? And there's some correlation here because generally if it's starting to cost you more, right? So there's two factors here. One, as an employer, you're paying more for what you're doing, right? To be able to have your doors open simply to have inventory or whatever you're doing for a lot of businesses, one, you're paying more. So that's a hit to your bottom line. But secondly, right, due to inflation, due to, the wage growth that actually comes with inflation, believe it or not, it costs more to employ people as well, amongst receiving less revenue. Because traditionally, like I said, during recession times, what happens? People constrict and they don't want to spend as much. So, what does that do to employers? What does that lead to? Insolvency. So, we've seen it all through crypto already. Companies that were over leveraged, right, or not doing the right thing, their books weren't good. And on top of that, they're servicing customers and and they're dealing with risky business. And so their margins from the get-go, they didn't set themselves up for success. So what do you see is you see a lot of things happen in a negative sense as far as employment goes. So when companies go insolvent or they say, hey, you know what, we're not making as much money as what we were before, that means people start to get fired on top of their wages slightly going up because of inflation. And so companies have to make some really hard decisions. And so here's an interesting thing. If you want to look at it, from a quarterly basis, so the cost of employment literally doubled, right? So to have your employees and be able to pay them the same and all this kind of stuff, right? It doubled. And so here's the thing. When stuff like this happens sporadically, this is when you start to see unemployment levels start to do something. And typically that means unemployment goes up. And we're already seeing that. And so this may be the beginning of that process. And we'll find out, like, I'm not trying to predict anything, but we will find out if these things actually end up playing out the way the data is showing. And so this sudden spike, because we were at zero point 0.9 and then we've doubled it to 1.8 as far as cost of employment. So that's just something to think about there. Let's go back. So I did want to take a look here. Let's look at this debt. So let's go to governments, debt. And as you can see, so this is in trillions. So last time I remember, and it's 30 trillion in debt, which is interesting, right? But the biggest thing is, and let's try to look at the last 5 years. I mean, this thing is just up and to the right. So the United States is taking up, because you're just like, where do they get all this debt from, right? But through time, we are becoming more of a society based upon debt. I mean, this chart is astonishing. And this is how much debt that the United States has. And so with that being said, like this is alarming, right? The United States taking on this kind of debt year after year after year, $30 trillion. That's a lot. And so the way, the crazy thing is the way that they counteract this, believe it or not, is printing more money. But in the long term adds more debt. And so, you know, this is just interesting stuff here, just kind of looking at it and just seeing the differences, right? So we're just seeing the federal government budget. So we'll look at the last 10 years. So compared to last year, I mean, things are just looking really bad, especially since COVID. They've constricted on their budget. Let's see here. Government spending to GDP. Da-da-da. All right. So this is pretty interesting. So here's the thing. It'll be interesting to see when it plots out for 2021. But if you just kind of look at these times, so this is the financial crisis. So government spending goes up. And so just kind of if you think about that, well, why is that? Trying to make up for what's going on economically, the issues going on. But then just in general, a lot of these things actually kind of lead into the issue, right? Them spending too much. And then so when you go into a surplus of spending, what happens after that? And so here in 2020, 44th, this metric, spending was also pretty high. And then the government revenues, let's see here. Huh, that's interesting. It looks like in the United States here, we got taxed like crazy. That's what I think of when I see this revenue spike. What is this? What month is this? In April. Interesting. So the government revenues, interesting spike here in April. So then this is just like a rabbit hole of us wondering, okay, well, why is that? And then, we can go through that process of just kind of understanding these metrics of how they fluctuate and change. And we could really, because this is really like looking at the books, right? We're looking at the books of what's going on in the economy. And as we know, crypto is highly, highly, highly correlated to what's going on here. And so paying attention, getting to know these metrics, understanding where they are today, and then what they look like in a month or two or three, whatever the case may be. This is how you stay ahead of the game with the information, so you're not going to miss a beat. And you can be that savvy investor that knows what to do during the right time. Let's see here. Central bank balance sheet. So here's the interesting one. So this one, right, it should be on a continual decline. So if we go, so as soon as here's the thing, as soon as they started raking interest rates, their balance sheet was supposed to be going down, right? Because their whole thing was, hey, to get the inflation down, what are we going to do? We're going to hike the interest rates, and then we're going to run off our balance sheet. So United States Central Bank, I mean, these are the shot callers. And so you can see it really only started, right, to start to decline here in May. So when they first said they were doing it, they actually really didn't do it. And just now, they're starting to run off their balance sheet. So with this being said, this kind of just gives to the credence that this metric needs to go down, and they need to actually enact what their policy is. Because this is what's really going on under the hood, not what they're saying in the meetings, right? This is what's going on. So if we look at the M2 money supply, now that is starting to go down. So that is slightly positive, but we want to see this metric start to go down pretty quick. And so that's just like a little look under the hood for what's going on economics wise. And so as we kind of close this out, let's take a look at Bitcoin. Let's see here. Let's go to Bitcoin and just see what's going on with that. All right. So let's start in a little bit closer, then we'll zoom out. Let's do 4-hour chart. So here in recent time, I'll take this off for now. Okay, so here in recent time, June, obviously this was a tough month. So the month of June, if we go from beginning of the month, so right about here, to to its worst, right? Negative 44%, but where we may finish out, right? It depends on where we finish, but we're looking at like a, give or take, 40% decline for the month of June, which is the worst, so to speak, month so far for Bitcoin price performance rise to the downside. Now, the interesting thing is that I noticed as I'm kind of, I was kind of looking at things earlier, this level here, right? So we started to wick down, especially earlier today. So this here, and this got defended so quick. And then so I kind of did some searching, and there's a lot of shorts that got liquidated at this point. And so we bounced up really quickly. We were touching 18,000 and some change. We really bounced up. And then this kind of got pushed back down here, but we bounced back up almost to 21K. So that's a pretty big swing relatively in a couple hours. So that kind of tells me something. It's like this zone here that we're in is a battle. It really is a battle for the Bears and the Bulls here. And so, the biggest thing is that we were, in this decline, and we clearly broke it to the upside. Now we wicked back down to it, and this is like super, super short term price action. So, we got to look at this as, okay, just immediate, not really saying, okay, well, where are things going to go this next month? This is just a look and say, okay, what can happen over the weekend, really, right? And so we broke this downtrend. And so what do we notice is like we've come down and we've had here, test a little bit lower, but right here, you see just things kind of settle. And you can take a look here with these candles here, that here, and this barrier here. And then we're back kind of right here, settling here. So that's an interesting point. And so the interesting thing is what we'll see is through time is how the price will react. Now, if we can use this support and rock it up, and what we'd have to do is for us to get a little bit bullish because you can see, hey, things kind of range. And so for things to look pretty decent, is that low end, right? So is that low end here, and we start to trickle back up, but we need to do some work, break this trend line here, hold it, and then break this other trend line here. So I'll put a price call. So for us, for the weekend, if you start seeing prices over 21,700, then and then we get a retest of that, things could look pretty decent in the short term. But nonetheless, if we do not hold, and because the thing is, if you look, this wick is getting bought or it's getting sold down pretty quick. And so that is kind of leading me to say, well, that may be the harder part of a journey for Bitcoin. The easier part would be for it to just kind of retest and then break back down. And then so on the bottom portion, if we were to break this level here, so over the weekend, if we were to break 18,700, then you kind of have in your head, okay, there's possibility for us to, go ahead and drop down to, 17 and some change, and maybe possibly even 16 if the weekend is tough and things are trying to be priced in for Monday. And so, and this is just relative. A lot of this price action is relative to how stocks are performing. And so, like I said, this was a nice thing to see, right? It just wasn't all bearishness. Like these two candles in particular, now this one being sold down, not so much, but seeing this at this level here at 18 and some change just means that, hey, there's people still in this market, guys. And so, like I said, it's a battle here at this point. And so kind of want to do a fib retracement from this bottom to this top. And then what do we see? And so, yeah, it kind of came down and tested that 786 level. So as you can see, where the resistance is, it's having a hard time and struggling to stay above the 0.382. And typically on the way up, if we could hold this and then also break past this 238 fib level and retest off of it, there's a good chances that we make new highs in this short-term cluster. But since this got sold down pretty heavily, like I said, that looks like the case that, it would be a little bit tougher for Bitcoin to do that, just going off of the data that we're seeing here. And so that's just going to kind of lead me to say, yeah, there's, looking like we'll have a little bit more downturn through this, this next period of time here, especially this next week. And so thing is, hey, dollar cost average, if you know your price levels, that's great. But if you're trying to say, hey, I'm just really just looking for a deal, hey, patience isn't bad either, right? And so that's just the short term for Bitcoin. Overall, we are still in this downtrend. And so let me pull up that regression band and we'll take a look at that. Matter of fact, I'll just do another one. So we can take a regression band from this top to where we are now. And so the thing is this, right? If we are able to break this 21.7 range, there may be a good case for us to continue to challenge this midpoint of this regression band. So just for example, when we've kind of gotten close to this bottom portion of this regression band, we've challenged the midpoint. Same thing here. We got close to the bottom, we challenged and actually went above this midpoint. And so same thing here, as we get close, there's not that much price history, especially in the short term, in this area. And so if more shorts actually get liquidated, right, that may just be the little spark in the short term for a little small relief rally. But like I said, the overwhelming theme here is, yes, this is a easy to identify bear market. And so that's kind of what we're looking at. So nothing too sexy, just basic price action, but having those levels in your head. So if you're looking at Coinbase or Crypto.com or whatever exchange you got for your onboarding of your crypto, you kind of see certain price levels hit, then you can kind of have an idea of where things may go, whether to the positive or to the negative side, if those are breached. But outside of that, let's check the fear and greed. Let's see where we're at. 11. And so, yeah, I mean, same thing. Typically, if you're a person who's investing when fear is high, doesn't matter the market, where people are capitulating, where people are looking to sell an asset, the game is, can you accumulate assets? That's the game. People who understand the game typically have a better shot of staying in this game and staying solvent, with their personal finance and not being under the thumb of the government, whether you're receiving funding from the government always and continually, or it's just, hey, you're just working every single day for the rest of your life. And I love working hard, right? But at the same time, you want to be able to get those dollars that you earn, trade that fiat that's not going up in value for things that can actually help you and your family. So that's the way that I see things. And I really think that when people really try to take a view at that in a way of not saying, hey, I'm not greedy for money. This is not about greed. This is solely about personal finance and how you're either going to let your finance rule you, or you're going to give your finance a job and you are in charge and on top of your finance. And so, yeah, that's pretty much it. That's all I got for you guys. Appreciate y'all for tagging along. That was just a little deep dive, nothing too crazy. But yeah, dollar cost average, learn how to take a good contrarian look at things and go off of what you see with your own personal eyes. Don't just go off of what I'm telling you or what somebody else on YouTube is saying. Doing research yourself and understanding things for yourself is the best way to grow, best way to learn. And that's what I'm about, is advocating you guys to try to do your best to put yourself in the best position that you can. So with that being said, that's all I got. And well, let's see here. Do I have anything else? That's it. Peace.